Welcome to Turbo Impact, where we navigate sustainability in private capital. I am your host, Kenny Chen. Each episode, we sit down with investors, allocators, and corporate leaders shaping the next era of sustainability. We explore how capital is driving the global transition and how today's decisions are shaping the future of impact. Thank you for joining us. This podcast is brought to you by Turbo Net Zero, a pure-play sustainability advisory firm driving impact across the private markets. In this episode, I sat down with Courtney Wei, Head of Investment at China Life Insurance Overseas, to explore how one of Asia's largest institutional investors is embedding sustainability into long-term global allocation. Courtney brings more than 20 years of experience managing institutional capital across asset classes and geographies, from global emerging markets to sovereign reserves. At China Life Overseas, she leads investment strategy for multi-billion-dollar balance sheet, guided by a liability-driven approach that emphasizes resilience, discipline, and real-world outcomes. We discuss how allocators are integrating ESG across the investment lifecycle, what sets apart authentic sustainability strategies from box ticking, and where she sees the most compelling return opportunities aligned with long-term impact. Here's my conversation with Courtney Wei. Hi, Courtney. Welcome to Turbo Impact Podcast.
Thank you, Kenny. Very honored to be here.
Can you start by telling us more about your current role at China Life Overseas? How do you like working as an institutional allocator?
Sure. I'm the head of investment at China Life Insurance Overseas. We oversee about 400 billion Hong Kong dollars in assets. My role covers strategic and tactical asset allocation, public and private market investment, risk control, investment operations, and etc. I also serve as a core member of our investment committee. I think what is interesting about and also challenging about insurance investing is that how it is different from other forms of investment. I would summarize that into three major differences. Number one would be asset liability matching. Insurance investing is fundamentally driven by our liabilities. Our portfolio must serve the needs of our insurance policies, which means aligning our cash flows, durations, risk exposures to the structure of our liabilities. Number two would be our balance sheet responsibility. When we are investing, we're investing the insurers' their own balance sheet, our own balance sheet. It's not a third party's capital, which means our risk appetite is going to be structurally more conservative and long-term oriented. Number three is that it is regulatory intensity, much more intensified. The insurance sector is heavily regulated, as everybody knows. In addition to usually when we think about investment, we're talking about optimized risk and return. In insurance investment, it is not just risk and return, but also we need to consider capital efficiency. In Hong Kong, we have a framework called RBC, risk-based capital, and that also directly impacts our investment as well. Since we are talking about sustainability investing here, I think it is interesting to connect those two things, how insurance investment differs from other investment and also how it connects with sustainable investing. I think it is naturally aligned with each other. It strengthens, sustainable investing. It strengthens risk management, supports long-term stability of the cash flows, and therefore supports our asset liability matching. and in the future has the potential to improve capital efficiency as well.
Thanks, Courtney. So from your perspective, how do you approach sustainability integration across the investment life cycle? Because you have exposure to different asset classes and different type of managers. So from top-down asset allocation to appointment selection and the monitoring managers, could you give us an overview about your approach here?
Oh, sure. So we usually, I mean, when it comes to um, sustainability investments, we take a systematic full cycle approach, which combines top-down strategic design and also bottom-up execution. So at the top-down level, we consider ESG or impact investing, sustainable investing, whatever you call it, into the consideration of our strategic asset allocation. This helps us to tilt our capital towards more future resilient asset classes and regions. And then at the portfolio and strategy level, we direct capital into sectors that align with strategic goals, such as renewable energy, healthcare, digital infrastructure, etc. This is both across private and public markets. And then at the implementation level, in our manager selection, in our due diligence and post-investment monitoring, we also look at those factors, ESG factors, etc. We have a scoring system when it comes to the annual evaluation of the managers and see, when we decide how good a job they're doing, we have those ESG factors considered in our assessment. So we believe ESG is not isolated function. It should be embedded in the whole system in terms of governance, decision-making process, performance measurement. In short, it's across the whole investment life cycle.
Can you tell us more about what liability-driven investing means for an insurance company like China Life, and how it shapes your global asset allocation strategy today?
Sure. Liability-driven investments, or LDI, I think for an insurance firm, it goes way beyond duration matching. Everybody talks about insurance investment, they talk about duration matching, but it is more than that. It is about, as I said, our investment should serve the purpose of our liability. So we need to align our assets with our liabilities across several dimensions. Duration matching is just one of them. We should also look at cash flow matching, return expectations, risk exposures, and etc. This allows us to maintain portfolio stability and at the same time optimize our capital efficiency under the Hong Kong RBC. So in practice, what does that mean to us? I think the first thing is we need to have a real good understanding of our liability. Everything starts with a deep and rigorous analysis of our liability. We need to understand the cash flow structure, duration profile, interest rate sensitivity, and embedded options or guarantees. And only after that analysis, we can start to have the right strategy to match that liability. So that's the first step. And after we have we got that, we start to align our in our investment with our liabilities. In terms of allocation, we have been using alternative investment in that process to have a better matching of our liabilities, especially in areas like private credit, infrastructure debt, PE secondary, kind of strategies like that. The reason is because they tend to provide predictable return and often inflation-linked cash flows and lower volatility and some other kind of attributes that works for us. So those are some of the attributes that's very important for us to construct our portfolio that supports our liability structure over the long term. So in short, 2 steps, if we have to summarize that into 2 steps, one is really have a real good understanding of your liability, and also, trying to find new asset class that can help us provide that match that serves our liability.
Is there a difference in how you think about sustainability integration when investing with an LDI lens?
Mm, sure. Sure. Yeah. When we look at the sustainability through the LDI lens, it does change the way we integrate ESG, because we must not only assess impact and the responsibilities, but also ensure alignment with liability characteristics, namely cash flow, duration, risk exposure, return expectation, capital efficiency, all those metrics. So for us, it is not enough to just to have an ESG friendly in principle, but also need to produce that type of return we need. Predictable cash flow, low volatility, reduced or efficient capital charge on the RBC. So specifically, we would be looking at assets. We talked about infrastructure debt, private credit, PE secondary, or kind of energy transition asset, etc. So I'm not sure I am answering your question, but I want to say that when we are looking at ESG or sustainable investing through the LDI lens, we're trying to not only answer the question, is it sustainable for the planet, but also trying to answer the question, is it sustainable for our balance sheet, for our stakeholder, for our policyholder for the next 30 years?
That's a very good answer, Courtney. So, from my understanding, you seek return and sustainability, and trying to balance the goal, right, for the next 30 years. So, what type of global asset classes or strategies do you find most compelling today, which can serve your goal here?
Right now, I think we are seeing opportunities across both traditional and alternative asset class, but slightly different logics. From a more traditional fixed income perspective, I think US fixed income space is now near historic high in terms of yield. I think it is creating a long-term value despite short-term volatility. We're seeing this as a strategic re-entry point, and we are allocating into, if we are going into the space, we're allocating into high quality investment grade fixed income, especially US dollar denominated bonds, to lock in yields and have a better duration profile for us. So that's for the more traditional space. On the alternative side, we think structure changes are happening in the markets and created some long-term opportunities as well. Factors like bank entrenchment, higher funding rates, better demand for private capital. Those are all reasons why there are a lot of opportunities in the private space. We talked about some of those categories like private debt, infrastructure debt, PE secondary, PE co-investment, etc. I think those investment, align with our liability profile, works. Some of those categories works really well with sustainability as well. So those are some of the areas we think is interesting. So in short, I think it's twofold. One is on the trying to capture the high interest rate environment. So by re-entering this space, but also increase structurally to resilient alternative asset class returns.
As an allocator to global GPs, what do you look for in a manager's ESG approach nowadays?
I think there are many textbooks talk about, how do you distinguish true ESG from service level marketing. We have people talk about governance, whether they have a dedicated committee on ESG, that we have people talking about integration in their investment process. Whether they're in their deal screening process, underwriting, monitoring process, etc., where people are talking about data disclosure and transparency, incentive and alignment, etc. Those are the textbook. I think there are many experts in the market who can talk about those. For us, we all obviously look at all those metrics, and we will ask all those questions when we talk to the GPs. But we always think more importantly is to evaluate the GPs, their own ESG behavior as an organization, their internal operations, their hiring practice, their environment footprint, and how they're managing their firm. So what we're asking is that don't just talk the talk, but also walk the walk. So it's not enough for the GP to apply ESG standard externally, but we want to see the consistency, both internally and externally.
That's a good point. Just following up on this, if a GP asks for your suggestion for one or two areas that you think they can enhance their internal and external ESG integration the most. So you mentioned internal workforce is very important. Are there any other points that you think will be worthwhile for the GPs to consider to enhance their performance in the internal and external ESG integration?
It's hard to name a specific area. I think, what they are asking others to do, they should ask themselves. If they're asking others to be, more environmental friendly, I think they should ask themselves, are you doing your share? If they're asking others on the social and organization front, I think they should probably looking at their workforce, whether they are taking care of their own people. So I think it just we just look for the consistency, and it's hard to name a specific area.
But are there any clear, obvious red flags to you if, for example, if a GP approach you and walk you through their ESG process, but oh, this is a clear red flag to an allocator. So can you share a little bit more of your observation and experiences here?
I would say it's hard to see the red flags, but I would see the kind of the nice to have certain things. If we see they are taking care of their employees, for example, if we see the practices in their workplace, if we happen to be in the office, I see the more inclusive workforce, that will be a plus for us. Um, if they are, there are practices when we are talking to the employees, we think should be helpful to keep the workforce uh, kind of to maintain the stability of the workforce. I think that will be a plus. And then in terms of their compensation, if they have kind of incentives to keep the workforce for the longer term, that will be a plus. So it's hard to say, what will be kind of a red flag, but I would say pluses is here and there we can see when we talk to GPs.
That's a great point here, Courtney. So what you suggest is enduring impact not only comes from integrating sustainability externally, whatever your strategies are, but truly comes from internal resilience, which is also embedded to the conventional, ODD, LDD process with GPs and from the internal standpoint, ESG integration is also very important consideration to LP.
Yes.
Okay. Are there any other particular sustainability themes that are gaining traction in your global asset allocation strategy today?
Um, I guess, yeah, we are looking at all as kind of strategies and aspects. Um, but I would say maybe a few climate change transition risks. We are seeing opportunities in this space. This will enable the global transition to a low carbon economy. This is where the world is going. I think by being there early, not only helps the environment, but also potentially help the return. Could include renewables, energy efficiency, green infrastructure, or kind of financing the transition of high emitting sectors, etc. So we guess that climate risk is both a physical and potentially could be a financial risk. So addressing it is can be an important strategy. So that's one area. Another area we have been talking a lot about is demographic shift and healthcare innovation. So as we know, population is aging across Asia and globally. We see opportunities in healthcare, digital health, elderly care, medical infrastructure, biotech, new forms of healthcare, etc. So those sectors offer kind of a stable, long duration cash flow, and it directly address one of very pressing social challenges. And another area is probably not a traditionally ESG area. I would say artificial intelligence and digital transformation, usually not considered part of ESG, but we think this AI development can be a critical enabler of sustainability. When we trying to find solutions towards climate change, healthcare, etc., they could be a very useful tool. So we are cautiously exploring opportunities in this AI-related infrastructure. uh, at the moment. So together, I think those are the things that reflects our conviction that sustainability is not about sacrificing return. It is about preparing for the structural changes that shapes the future economy, and at the same time aligning our capital to both uh, kind of mitigate risk and unlock opportunity.
Thanks, Courtney. Following up on your uh, opinion on your comment between the sacrifice between return and sustainability standpoint. So when you think about the relationship between return and sustainability, do you think it's a trade-off or it's a hand in hand? They complement each other. Would love to get your point on the relationship, how you view between return and sustainability standpoint for all of your investments.
We think longer term, they should be complementary, not contradictory when it comes to long-term horizon. But in the short term, there could be trade-offs. For example, if we're talking about the high carbon sectors, right now they may offer attractive returns, but they could have long-term risks, transition risks that could be quite significant. So in the short term, they don't always work together. But in the longer term, we think they, those sectors, ESG aligned assets tend to demonstrate greater resilience, uh, lower downside risk, and more consistent cash flows. They could be supporting each other in the longer run. So, but we also think it is more important to look at sustainability as a source of alpha. So early investment in those sectors like energy transition, kind of all kinds of resource efficiency could deliver strong financial performance as the rest of the society evolves towards that direction. So if we are early in that process, that could be a source of alpha, help both society and also generate return.
From an allocator's perspective, what are some of the key challenges you are seeing when it comes to integrating sustainability today?
I'm sure you have other experts in this area who can talk a lot about this. As I mentioned, when we're talking about ESGs, what to look for, and in terms of challenges, I think it's in the same areas. We could be looking at data quality and or lack of quality there. We could talk about the standard or lack of standard there when we talk about green, when we talk about impact, when we talk about sustainable investment. What does that exactly mean? There is no kind of clear definition that can be applied across the world. And then in terms of implementation, there are many barriers as well. Incentive alignment, maybe they're not well aligned, etc. Those are all potential challenges in the implementation. But for insurance capital, I would like to mention one thing, that is regulatory capital treatment, specifically RBC consideration. Right now, we don't see strong kind of support from the regulators that pushes us towards that direction. Right now, for us to invest in certain sectors like infrastructure debt, infrastructure equity, we don't see that kind of a similar kind of treatment as you would see in other parts of the world. For example, in Europe, if you invest in infrastructure related debt or equity, you will have better capital efficiency. We don't see that in Hong Kong yet. So for us, I think the next thing we are trying to do is to talk to our industry peers, we'll talk to regulators, and we want to kind of move the industry towards that direction.
As a woman leader in institutional investing, what advice would you offer to the next gen of women leaders who want to get into your field?
Mm, I think there are many advices out there. I will probably add only two things. I think one would be to lean in and not hesitate to engage and not hesitate to engage fully, not just at work, but also in the community, in the broader ESG ecosystem. Uh, ESG incorporates or connects many aspects: finance, environment, society, and we talked about regulation, so that's government as well. So women leaders should see themselves not just as capital allocators, but also change makers. So whether it is participating in policy dialogue, speaking in the industry panel or mentoring others, I think it is important for the female leaders in the industry to know that our voice matters. So I think that's number one, to lean in. And then number two, I think uh, it is um, it is important to be self-aware that as female investment professionals, we tend to be more conservative than our male counterparts, which can be a strength and a limitation at the same time. So while prudence is important, especially when it comes to managing institutional capital, it can also mean that sometimes we are too or over caution. That could lead to missed opportunities, whether it comes to innovation, asset allocation, or leadership, etc. So we should have that kind of a self-awareness that don't be too or kind of overly cautious. So in the end, I think to be a strong female leader in this area, I think it means to balance rigor with vision and caution with courage.
I ask every guest this question. What do you think is the most effective way to turbo impact in your field?
Mm, um, I think probably two things as well. Number one is thought leadership. If we really want to cause change in whatever areas, especially in the areas of sustainable investing, I think thought leadership is very important. As institutional investors, we have both a platform and the responsibility to shape the industry. So which means we should think about producing deep evidence-based research. We should participate in industry forums, publishing views, and uh, by doing all those things to help align stakeholders across regulators, the industry, the financial aspects, civil society together in terms of sustainable investing. True transformation happens when capital providers help create and shared understanding among different stakeholders. So I think number one is clearly thought leadership. As number two, I would say, is by talk the talk and walk the walk. And again, by using the capital we are entrusted to align our long-term capital with sustainability objectives. So it goes beyond, the basics, the scoring. It goes actually. We should direct capitals into areas where we could solve some of those long-term challenges, be it climate, be it healthcare, be it social issues. We can use the capital entrusted with us to cause those changes, and by kind of getting the financial return, and at the same time shape a more future-ready economy. So I think, in short, to answer your question about turbo impact, I would summarize into kind of three things: think deeply, speaking clearly, and allocating towards those areas.
Thank you again, Courtney, for joining Turbo Impact.
Thank you for having me.